And welcome to this Tier Markets webinar on leverage. What is leverage? What does it mean? Leverage really means, in very simple terms, it means you take the money that you have and you can do more with it than the face value of it actually says you can do with it. Okay, you can make purchases or trades beyond the face value of your current balance. Okay. It's a word you hear a lot in the retail foreign exchange sector. It's obviously gives you the ability to take much bigger position sizes than your actual balance, but in so doing, you should be very much aware that it obviously increases your risk and obviously increases the opportunity for you to suffer losses on your positions much bigger than if you didn't have any leverage. Also very important to note too that Tier Markets offers two entities that you can trade out of. The first one is in the UK, the second is in St. Vincent and the Grenadines. Under the UK entity, the maximum leverage you can have is 30 to 1. 30 to 1. That leverage is not controlled, if you like, by us. It's not set by Tier Markets. That is set by law, by European law. That is the maximum leverage you can have under a UK registered broker. Okay, 30 to 1. You can have less, obviously, anything down to, essentially having no leverage at 1 to 1. But the maximum you can have is 30 to 1. That is not changeable. Okay, that is by law. We have to make sure we adhere to that. Alternatively, you have the St. Vincent and Grenadines entity, and on there we offer leverage as high as 500 to 1. Okay, 500 to 1. Now, in the MT5 demo I have in front of me, I want to take you just down here, we have no open positions, just to our current numbers. Okay, the balance on this account right now is $25,550. Okay, the leverage on this account, it's a demo account, is actually set at 100 to 1, 100 to 1. So that is equivalent in terms of being able to place trades at 100 to 1 of you having $2.55 million in your account. Okay, that's what a 100 to 1 leverage does for your account. Right, so quite a substantial difference. Now, the best way to show how leverage works, at least within the MetaTrader environment, or what it permits you to do, is probably just for me to show you a couple of examples in terms of putting on some trades. What I have up here is I just bought up dollar yen. I'm just going to keep it simple. Why have I bought up dollar yen? I bought it up in dollar yen because this demo account is funded in US dollars. And this currency pair here, dollar yen, is quoted in dollars. Okay, so you're going to trade a dollar amount. We'll just keep the math a bit simpler and get the concept over, I think, much cleaner. So if you wanted to place a trade, let's say you wanted to place a trade in dollar yen. Now you've only got $25,000 in your account. Let's say we're going to bring up a deal ticket, double click the price as always. Let's say we want to bring up a trade for one standard lot. Okay, now tells you here one standard lot is equivalent to $100,000. Well, how can I take a $100,000 position when I only have just over $25,000 on my account? That's 4 times what I have in my account. Surely that's not possible. Well, let's hit the buy button. It certainly is possible. Okay, you've just bought $100,000, 108 spot 575. So how does that work? Well, you've got leverage on your account. Out of this particular example, it's only 4 times what you have in your account. You have 100 to 1 leverage. But this is how it affects your account. Okay, you got your balance. That's where it was to start with. You got your equity. Well, what is equity? Balance less your P&L, or less a loss, add a profit, is equal to your equity. Okay, so have a tiny loss, you see your equity is just a fraction below your balance. Margin. Margin, really, 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 really important, because margin really determines what you can and cannot do with leverage when taking positions. Now, we know our FX pairs are margined at 1%. Okay. So what does that mean? That means out of your equity here, you have to take $1,000, which is 1% of the face value of the trade. Right? That's 1% of $100,000 has to be placed as margin. Now, you haven't lost that money, right? You're just putting it up as collateral, if you like, for you to be able to take that trade. Okay, so that's what you have to put up. You put up $100,000. You've done $100,000 trade. You've got to put up 1% of the face value of that, which is $1,000 as margin. Okay, that will then tell you that your free margin, what you have left to use as margin, will be whatever your equity is, less what you've already got in use as margin if you have an open position. So now you've got $24,546. So that's how you can open a position when you have leverage for much larger than your account balance, and how the system treats it. Now, got $100,000. Let's say we wanted to buy $1 million, all right? That's 40 times our account balance. I've got $25,000 on my account. I'm going to have a $1 million position. Watch. Open it up. A $1 million will be 10 lots. See over here, beautiful dollar pricing today, all choice prices. Boom. Right. I just bought $1 million yen at 108.571. Let's go back over here. Let's see what's happened. Our balance has not changed. Okay, that's what it was to begin with. We haven't realized any profits or losses over here, so our balance is exactly what it was to start with. The equity. The equity is the balance plus or minus your P&L. Right, so you got, well, it's obviously flicking around a little bit, but yeah, that's how that number is calculated. Margin. Well, that was 1,000. Now it's jumped to 11,000, right? Because we've taken a new position of $1 million. The system will charge us, get us to put aside 1% of that, which is equal to $10,000 as margin. So we've got $1,000 of margin from the first trade for 100,000, $10,000 from the second trade of $1 million. So we've got a grand total of $11,000 now put aside for margin, which leaves us $14,536 of free margin in order to be able to open new positions. Well, you know, let's kind of bullish on dollar yen. Maybe I want to buy some more. Right, let's go and buy, let's go and buy 20 lots. Let's go and buy 2 million, right? Because that's going to give me 2 million. That's going to give you $3.1 million of positions. $25,000 bounce. Well, that's pretty good, right? That's pretty good. But let's see what's going to happen here. Oh, not enough money. What happened there? Well, I tried dealing in 20 lots, which is $2 million, right? So if I want to do this $2 million ticket, I have to put up 1% of the $2 million as margin in order to be able to open that position. 1 million there, 1% of the 2 million is 20,000, but I only have 14,000 and change free margin left. So I can't open that position up. It's too big. The system will automatically stop you. The important thing you have to understand as well, and I'm going to do this just as a quick example to show you. Not only do you have to have what is called initial margin, and this isn't how it's labeled here, but I'm just going to use what is the correct terminology. You need an initial margin in order to be able to open a position. But you also need what is known as maintenance margin, which is to be able to keep the position open. Okay. Now, I've got 14,536 there. If I open a position up for $1.4 million, which is 14 lots, okay, it's going to charge me $14,000 of margin to put up there. So then what happens? All right, well, let's go see. Boom. So I've now got a grand total of, I've got 1.4, 2.4 plus the 0.1. I've got $2.5 million worth of open positions based off an account balance of 25,500, right? Almost 100 times, which is what we have, right? 100 to 1 leverage, 100 times what our balance was in terms of open positions. We've got $2.5 million of open positions out of just $25,500 in our account. It's put aside $25,000 of initial margin in order to be able to open those positions. So it's all good, right? What goes from here? What goes from here, you have to keep in mind, is this number here is your free margin. This will include what you need to be able to keep the position open. What does that mean? This number here constantly goes up and down, right? It revalues at the market. If this starts moving against you, right, so loss, once it gets more, that loss becomes more than that free margin, you're going to have a problem on your hands. The system is going to start liquidating you, okay? Because you will not have enough maintenance margin to be able to keep that position open, right? So you put on the big positions, but you haven't given yourself any room to actually run it, okay? You've only got $500. So, in dollar yen terms, you got $2.4 million worth of positions. To run it $500, 3 points against you, and you're going to have a problem on your hands. So you've got to keep in mind you're increasing your risk, but if you want to increase your risk, you've got to make sure you've got enough room to be able to run that position, because otherwise you'll find yourself getting liquidated almost immediately. Especially one thing you've got to be very careful of is at a time of day, say, just after what we call rollover, which is the new MetaTrader trading day after 5 p.m. New York time. Spreads tend to go wider, and there's a danger if you have too much risk on that those widened spreads after 5 o'clock could cause your floating P&L over here to move against you, and you could unfortunately get liquidated as a result of just widening spreads. Not necessarily the market's moved, but widening spreads. So these are all things you need to think about when you're trading a leveraged account. It's a great tool to be able to take more risk and to be able to trade larger amounts. But it's really, really important that you understand the associated risks of so doing. If you have any questions or concerns, please speak to one of our support staff. In terms of the St. Vincent entity, you have, as I mentioned, up to 500 to 1 leverage. The right number for you, it could be very different from the right number for someone else. Okay, so you need to understand your risk, understand what you're comfortable with, and then set your leverage appropriately. As a rule of thumb, you can start off as small leverage as you want, get comfortable, and gradually work up is probably the best way to go until you get to a level at which you're comfortable. I would, unless you are a very experienced, seasoned pro, I would not go all gung-ho with as big as leverage as you can find. Okay, please, please, please pick a leverage at which you're comfortable. So this is how leverage works. Okay, it allows you to take positions far greater than the balance in your account, but you will be charged. And when I say charged, you're not actually physically getting the money removed from your account, but you're having to put aside a certain amount of money to be able to hold those positions, which then means you're left with a lot less free margin in order to run those positions, especially if the market starts to move against you. So that's what you need to keep in mind. Now, what happens if I've got these dollar yen positions with, look, we're up $150. It's pretty good. Well, let's go and sell one. What am I going to do here? What am I going to sell? Well, okay. Now, as we all know in Meta, you've got this wonderful hedging. I sold 100,000. Well, that's not much good, is it? I don't want to sell 100,000. I wanted to sell 1 million. I put in the wrong amount. So, let's sell 1 million this time. 10 lots. Okay. We'll sell. Boom. Okay. So we just sold 1.1 million there, the 1 and the 1.1. So what happened? Well, we had we had margin at 25,000, but we just sold it 1.1 million out. So by selling 1.1 million out, 1.1% of 1.1 million has now come off our margin, right? Because we've reduced our net exposure. Okay, we've reduced it. We put a hedge on against it, as Meta so beautifully likes to say. Now, if we didn't really mean to hedge it and we meant to close out against, there's this wonderful system here. But if you double click on one of these two tickets here, let's say you just wanted to close them out against each other, rather than crossing two spreads, you can double click on one of them. Doesn't matter which one. Up here where it says market execution, go down to close by, and then it's going to give you the opportunity to close against one of the other tickets without crossing a spread. So we'll close the 100,000 ticket. Let's close it with this 100,000 ticket there, close position, and you're about to see those two trades here disappear. Boom, gone. Okay, didn't affect the margin because we didn't decrease our exposure. We just tidied that book up. Let's see here, right? We got the 1.1 against the 1 against the 1. Do the same thing. Go up here, close by, double click on that. This is lit up, and boom, out. So all we have left is the 1.4 million we originally had. And again, just to show you, just from a margin perspective, let's say we wanted to sell 400,000 of that. We can double click on it. We don't have to do 14 lots of the 1.4 million. We can do 4 lots, so that's 400,000. And we can just do that. What happens? Down the bottom, we were 14,000 margin. Our margin has now gone down to 10,000 because we just got rid of 400,000 of position, which is 4,000 of margin. And as you can see, we're just left with the $1 million position. And if we close that out, boom, nothing left. And our free margin is now back to being equivalent to our equity, back to being equivalent to our balance with no open positions. And we go back to our history over here. You're going to see these trades put in, and you're going to see, you know, we made 103 and 36. We made about 100 and a penny shy of $140 on that. Not bad. Not bad. Still got it. The goal here was not to show you how to make money. The goal here was to make you understand leverage. Okay. So for each position you take, you will get charged margin. Okay. That is going to be a percentage of the notional value of the trade that you're doing. You need to make sure you have enough room, enough money to be able to take that position so you can get that margin put to one side. And remember, there's two margins: the initial margin, which you can see, and then the maintenance margin, which is something you can't really see, but you just want to make sure you have enough room to run the position. You don't want to take a really big position and then find out if it moves 2 points against you, you have no margin left and the system starts liquidating you. Okay, so very important to think about. You can play around in your demo accounts. You can get the leverage on your demo accounts changed. You can have 2 demo accounts with different leverage settings, so you can do similar trades but with different leverages. See how that works out. Please, please, please get a really good, strong understanding of leverage before you start using it. It is a great tool to have. It can certainly give you a lot more, as they say, bang for your buck, but it does can significantly increase your risk exposure, and with that, potential losses on your account as well. So, as I said, please be very careful with that. And again, if you have any questions, please do reach out to one of our support staff. Thank you, and we wish you the very best of luck with your trading.